I admit it, when I was a 16-year-old, I was a horrible driver. I hope my mom's not listening to this. I wasn't always a bad driver, though. There were moments when the training that I got from my parents and my old football coach and driver's ed teacher, Coach Wilfong, really stuck. One drive in particular, I'm driving home about a 5, 6 mile drive during snow and icy conditions. And I was on a flat road in our old Datsun V210, and in a place I would have never thought I would have slid, I hit a bad patch of ice, and I actually spun around 2 times. It was really terrifying in that moment, but instinctively, I did do some things right. I turned into the slide. That it's kind of counterintuitive to go into the slide, but that's generally the right thing to do. I also remember my old driver's ed instructor saying, don't overcorrect and overreact. And I guess I didn't do that either. So I ended up, after spinning, right in the middle of the road, and I was terrified. And yet I was unharmed. But I can assure you the rest of the drive home, I was pensive and very timid, and I inched my way home, but I did get home. I think about the markets today, and it's a bit like these icy conditions that I described when I was a 16-year-old. There's definitely some things under the surface that are concerning that we don't have all the answers for. And we certainly don't know maybe what all the landmines or slick spots, if you want to use that analogy, are in this economy. But we do know that they exist. We do know that there are issues that we have to be thoughtful about. But all the issues aren't bad either. And like the driving on ice, I think it's important that we don't overcorrect. And it's important that we also kind of steer into certain decisions that help us allow the markets and the economy to recover. And if we don't take those right steps, there's a good chance we'll find ourselves still in the slick spots of this economy. So what are the things that we're looking at right now that give us some hope that things might be getting better? Our partner firm, City National Rockdale, is one of our investment strategists, produces some really great information that's very helpful when we evaluate the economy and the markets. Our slide in front of us here talks about the US economy, and these are just some different indicators that they look at when they assess what the strength of the economy is. And largely, other than CEOs of large corporations, most of the indicators in the surveys indicate that a recession doesn't seem imminent. Now, CEOs are certainly more guarded in their views, and that's something to take note of, but everything else looks a bit more moderate or more encouraging. City National Rockdale has been using these speedometers since 2008, the great financial recession, and every month they update these. It's 20 different economic indicators that most economists look at as sources of information about the pulse of our economy. And this is a very intuitive chart. Green's positive, yellow's cautionary, and red's bad. And right now, when we look at this, even though it's not a predictive tool, it does give us a sense of what these different economic indicators are telling us about the economy. And right now, I would call this moderate to moderately positive. There's not really much red on the chart. There's a decent amount of cautionary indicators, but there's still definitely some positive indicators. And then the little speedometer needles tell us right now where they think we are on those ranges. And then you'll see some light gray needles on a few of the indicators, and that gives you a sense of the movement from the prior month. So we definitely are seeing movement in the economy, and many of the indicators have gotten a little more cautious or pointing more negatively. Interesting enough, though, market valuation of securities, of stocks, is actually improving because of the recent volatility in the markets. So even in times right now where things are not super fun, that's part of the pathway for us to get out of this bad funk and get into a better market condition. When we look back over history, during other periods of time where we were in more recessionary periods, these indicators tended to be more red and more yellow on the chart. So again, not a predictive tool, but it does give us a sense of economic strength. Now, the big thing that I think has been weighing on all of our minds lately is inflation. And inflation definitely continues to be a problem area. And it will continue to be a problem area for a while. But we don't think it's going to stick around as long as some people do. Now, time will tell. But when we look at the data on this chart, it's signaling that some of the high inflationary pressures in our economy are going to moderate later in this year and early next year. So we don't think this persistent higher than 8% inflation rate will continue forever, but we do think this year will be pretty painful, but then starting to improve next year. And we think that's encouraging, and that should help stocks and bonds alike. And this chart reminds us that there are different forces going on in inflation. So oftentimes we think of a particular item that is very inflationary. And all of us right now, it feels like every time we go to the gas pump or we go to the grocery store, we feel it. Everybody's feeling that. But that's not the only thing that we ought to be looking at. There are many other forces in this economy that drive inflation, and not all of them are bad. And that's the key. We definitely want to recognize there are bad things, understand that. It's a bit like that spinning sensation I had when I was 16 years old. That was bad, but not every part of that road was icy. Not every part of the inflation market is icy right now. There are some areas that are improving, and those are going to help bring the overall inflation pressure down. But you can't ignore the markets have been bad this year. But markets do this. Markets go down from time to time. And I love this chart because it reminds us that oftentimes when we're in the depths of a downturn in the market, it's hard to believe it's ever going to reverse fortune. In fact, people will even say occasionally, well, how much longer before my money goes to zero? Well, it hasn't ever happened before, broadly speaking. Certainly stocks have gone to zero, but those are even exceptions. But the broad market has never done that. I love this chart because it reminds us that we've been through other very painful periods in stock market history. And so this goes back and looks at other times where we've had 100 days of just punishing returns in the market. And it's hard to see the sun when it's that dark in the stock market. But you can tell from the chart, many of these periods, there were strong rallies that followed. Now, we don't know how this year will end up. It may not recover this year. It may take into another year or so. But it seems likely with a lot of the economic strength that the markets could rally and probably will rally to some extent. And short-term volatility is very normal. Now, this is a chart that I love to use with some regularity because it's a great reminder that the stock market is always filled with some volatility and uncertainty, even in good periods. So this goes back to 1980, and all those bars indicate what the finishing result of the S&P 500 was. And so when you look at it, you can see in total, the markets are up considerably more than they're down. But there are isolated pockets in there where those down years some of them were quite painful. But even in the good years, if you look at the red little dots or box with the numbers, that shows you what the low point was of the market in that year. Now the bar tells us where it finished, the dot tells us where the low point was. And I love the example of 1980. Go to 1980, the markets finished up 26%. But along that path, there was a 17% decline in the Standard & Poor's 500. And I always wonder how many people sold out when it hit minus 17. And when they did, they locked in their losses. They didn't get a chance to get back to breaking even. And then they really lost out on that big 26% positive return. Even in good years, there's usually an element of pain that we have to go through. On average, the stock market drops about 10% about every year. And it drops 5% multiple times throughout a year on average. And then occasionally, and it's more in the 2 to 4 year range, the markets drop 20%. And that's one of the moments that we're in right now. And so we'll have to wait and see how long it takes us to recover. But I would just say this is not that unusual. And as I always like to think of, when there's bad things, it's a little bit like when you have lemons, you make lemonade. Well, we're in a period of we're filled with lemons in the economy, but let's make some lemonade. And so we're doing a lot of tax planning in these times, but we're also looking, saying, well, stocks got a little frothy in their returns in the last couple of years. And now when we look at pricing, we look and say, pricing of stocks is not cheap, but they're not high now either. And that's always a good thing. Get pricing kind of back in order. And that's where our economy is pretty beautiful, in that it kind of rights all the excesses. It eventually kind of goes in and fixes anything that gets a bit out of balance. And so now we're getting a stock market that's priced a bit more accordingly to the economy, and that usually spells good things. So I think back to that time I was spinning in circles on the highway back to my house, and how uncertain it felt in that very moment. But it wasn't very long after that I eventually got on solid footing, or my tires got better traction, and that was in my past. And I definitely learned a lot from that. And I believe I've always been a much better driver in inclement weather because of that moment. And so it's good to also remember that these moments in markets and economies are usually things that help us become more disciplined. And when we're disciplined, we usually make better money decisions. And that's important. It's important to remain calm. It's important not to overcorrect, like my driver's education instructor told me. It's important to sometimes even steer into the slide, if you will. And so right now, look at your portfolio. If you have cash on the sideline, maybe it's time to deploy some of those while the pricing has adjusted. Maybe it's time to do some tax planning and do things like Roth conversions and take advantage of these market conditions. But the big thing that's important is not to panic. Make reasoned decisions. And if you have any questions, go back to your financial plan. Give us a call. Let's visit about your plan, your goals, and find out where you are in relation to those. More often than not, we're doing far better than we realize. But the markets will remind us on a regular basis of those pain points. And it's important that we put those pain points in the proper perspective. Well, I hope you travel safely on your journey to your most pressing and important financial goals. I hope that this is helpful for you. If we can be of any assistance while you navigate these conditions, let us know.